Millions of people in both the United States and the United Kingdom, as well as Europe, are sitting on personal pensions that are barely growing. Now, that's got to be worrying you. Some haven't looked at their pension in 5, 10, even 15 years. Meanwhile, the market has boomed, even taking into account the recent drops in the market. Your pension probably hasn't boomed at all, or it's boomed in the wrong way and just exploded. The brutal numbers are these. I'll take the UK and the US markets. In both, over 50% of private pensions have not beaten inflation consistently over the last decade. In the UK, the source for that data is the FCA Retirement Income Market Data 2023. In the US, the data for that is, amongst other sources, Charles Schwab. 1 in 3 people are paying fees over 1%, even as high as 2 to 3% in some older pension policies. In the UK, the source for that is PensionBee. In the US, there's multiple sources for that data. A $100,000 or £100,000 pension growing at 3% net of fees over 20 years turns into $180,000. Compare that to 7% net of fees, which would become almost double. Okay, that's a $200K difference for doing nothing, because fees and growth become the problem. And we're only talking about a little bit of growth. Instead of 3, 7%. When you consider that the S&P 500 as an index tracker has been doing 15% per annum, you've really got to ask yourself, what are the common reasons for underperformance? Well, they are these. First of all, old-style pensions from the 80s, 90s, and early 2000s, which are charging high fees and offering poor fund choice. Neglected SIPs, maybe, or 401ks with poor diversification or cash drag. You've not looked at it. The world's moved on. There's new companies, better investments you could have made. Maybe you stuck in some old industries just because your dad or mum gave you those stocks. You never moved on. Or advisor-led pensions. This is the big problem, that charge 1 to 2% per annum and deliver little or no outperformance of, never mind the market, but even just basic index trackers or exchange traded funds. Okay, they call themselves active funds, but actually they're just lazy. In reality, they don't do anything for your pension. So what are the action points you ought to take? I want you to follow me for more videos like this, but also to save this video. First of all, track all your pensions. There are government services, both in the UK and the US, where there are free tools to locate forgotten old pensions. In the UK, it's on the .gov.uk website. You can do a Google search for .gov.uk, find my pension. There's similar services from the US government as well. Just make sure you're going to an official source when you're looking for your pensions. Okay. Request a pension statement. Ask for a current fund value, growth over 5 years. Check how it did when the markets fell last time in 2022 so sharply, and ask for annual charges. If the return is under 6% per year and you're under 60, it's underperforming. Simple rule. Okay. If fees are above 1%, you're overpaying. Find out how and if you're paying double fees. What do I mean by that? Some pensions charge a platform fee and an advisor fee, plus fund charges. And then that fund invests in other funds from the same company group. Find out if that's actually happening to you. Ask your provider for a full breakdown in pounds or dollars, not just percentages. Percentages are really easy to hide a lot of sins. Ask them how much you're actually paying in hard dollars or hard pounds. Consider transferring to a modern low-cost SIP. There are many online providers for SIPs or 401ks in the US. Okay. Consider exchange-traded funds in the UK or the US. These are funds which are a lot cheaper, and they track various indices. But just check the volatility on these. You can go to somewhere like Google Finance, see their historic price charts. You can also just put the ticker symbol of that exchange-traded fund you might be interested in into Google Finance or Yahoo Finance and see how it's historically performed as well for yourself. And on those company websites, because if you put the ticker symbol in, the company website which has issued that exchange traded fund will pop up, and you can see what they're investing in for yourself and decide whether you want to select that fund into your portfolio or not. Even if you're moving to a passive global equity fund, which might be the FTSE Global All Cap or S&P All Cap Global, average should be about 8 to 10% return, and that can transform your pension. That's a sort of buy, hold, and leave it. I'm talking to under 60-year-olds here now, not people who are just about to retire, where you might want to hold more cash. Now, if you want to get expert guidance, the US and the UK have official sources. In the UK, it's moneyhelper.org.uk. It's a government website. I want you also to have a look at campaignforamillion.com. It is a free set of tools I've created to help people add an extra million to their pensions over their lifetimes. Let me give you some maths on this. Okay, if you can increase your returns by 1%, that would mean 85,000 more over 30 years on a 150k pension. 85,000 more over 30 years on a 150k pension. Okay? If you had 1% lower fees, that would mean 100,000 more in retirement for you. Okay? Over the same period. Those are big numbers, starting from small pensions. Okay, so if you don't check your pension, someone else is profiting from it. That someone is likely to be a provider or a financial advisor or a wealth manager, or probably St. James's Place. You worked hard to earn and save. Don't let lazy investments drain your future. There's one thing you've got to have time for. It's got to be this. Now, like I said, like and follow for more videos like this. Save this one. I'm going to go back to doing a bit more research on some of this data, which has truly shocked me. I didn't know the situation was actually this bad. Right? I'll see you soon.